So, picture this. It's March, year 2000. There's this 37-year-old marketing manager in Seattle, and he decides to take a massive leap, putting literally his entire life savings into a single tech stock. Now, in his head, he definitely wasn't gambling. He'd done his research, he totally believed in the company, and honestly, for a while, it looked like the absolute perfect move. I mean, the stock shot up 300% in under 2 years. The guy felt like an absolute genius. But then, well, you know what happened. The dot-com bubble completely burst. By 2002, his investment was practically dust. He lost over 90% of everything he put in. And you know what's truly devastating about that kind of massive personal loss? He wasn't alone. Not even close. This exact same pattern, these precise mistakes, they've trapped literally millions of investors in this vicious cycle of crashes. We saw it in the dot-com crash, right? Then we saw it again in the 2008 financial crisis. And yep, we saw it just recently with the 2022 crypto collapse. These are recurring traps. But what if I told you these exact mistakes were already identified and solved decades ago?
In today's Explainer, we're going to methodically break down the 6 catastrophic historical investing mistakes from Benjamin Graham's absolute masterpiece, The Intelligent Investor. The speculation trap, Mr. Market, the crowd, overpaying, diversification, and the margin of safety. And finally, we'll reveal the 2 distinct paths forward for you.
All right, let's jump right into mistake number 1, the speculation trap.
This is probably the single most common pitfall out there, confusing the absolute thrill of speculation with the actual rigorous discipline of true investing. Benjamin Graham laid out a definition for investing way back in 1934, and it requires 3 very specific things: thorough analysis, safety of your principal, and an adequate return. Listen, if any single one of those is missing, you're not investing. You are speculating. Think about, say, buying a trending crypto token back in 2021 just because it doubled in a week, or jumping into some overhyped EV IPO purely because the media keeps calling it the next big thing. Did you do thorough analysis? Nope. Is your money guaranteed safe? Zero chance. That's just gambling against Wall Street pros who literally built the game to profit off your fees. Look, if you really want to speculate, Graham says keep it in a separate, tiny account. Just don't mix entertainment with your financial future.
Moving on to mistake number 2, letting the market control your emotions.
Your greatest enemy in investing isn't necessarily the economy itself, it's the psychological enemy within. And this is largely driven by a character Graham invented to explain the market's completely erratic behavior. Imagine you buy a 10% stake in a really successful local bakery for $1,000. And because you own it, you've got this business partner named Mr. Market who comes to visit you every single day. One day, he shows up practically vibrating with excitement and offers to buy your share for $1,400 because, quote, bakeries are the future. But then, a few weeks later, he shows up unshaven, totally terrified about the economy, and offers you just $600 for that exact same share. But you look out the window, and the bakery is still packed. They're selling the exact same amount of bread. This brilliantly illustrates why you absolutely cannot let the market's daily manic mood swings dictate your asset's true value. Mr. Market is completely emotional. An intelligent investor ignores his moods and only engages when his prices are wildly in their favor.
So this crucial point is perfectly captured in Graham's famous quote. In the short run, the market is a voting machine. In the long run, it is a weighing machine. Let's look at the historic A&P grocery chain. Back in 1938, fear and panic priced the company's stock at just $36 a share. That valued the entire massive business at roughly $126 million. But Graham noticed something incredible. A&P's cash and assets alone were worth $134 million. Mr. Market was in such a total panic that he priced the company below the cash it literally had sitting in the bank. Intelligent investors bought it, and as that weighing machine kicked in over the next few decades, the price correctly readjusted.
Which brings us to mistake number 3, following the crowd.
Look, when it feels like absolutely everyone around you is making money, that is the exact moment an investor is most likely to get destroyed. If we look back at the market from 1900 to 1924, things were relatively quiet. But by the late 1920s, everybody was in. You had taxi drivers giving out stock tips, banks were lending massive amounts of money to everyday people just to buy shares. It became highly fashionable. But here's the thing, popularity in investing is actually self-defeating. Think about it. If a restaurant becomes popular, they just feed more people, right? But when a stock becomes widely popular, its price skyrockets. And a massively inflated price simultaneously eliminates your future returns while maximizing your downside risk. That exact dynamic led directly to the brutal market collapse of October 1929. High prices equal more risk, period.
Let's look at mistake number 4, overpaying.
It is an absolutely critical fact that buying even the most incredible, highest quality business in the world will destroy your wealth if you pay the wrong price for it. You really have to understand the difference between projection and protection. So imagine a company earning $2 a share. One investor expects steady, moderate growth, so they pay a sensible $30 a share. But another investor imagines this flawless, unstoppable future growth, gets completely hyped up, and pays $80 a share for the exact same business. Now, what happens if the company grows but just kind of not as fast as the hype demanded? Well, that $80 stock will inevitably crash down to $40, destroying half of that investor's wealth, even though the company itself is still totally healthy. When you rely on guessing the future, which is projection, you are setting yourself up for failure.
So how do you actually secure protection instead? Well, Graham lays out 5 specific signals. You want to look at knowable, concrete facts. What are the long-term prospects? Is management honest about their failures? Does the company have the financial strength to survive without relying on bank loans? Have they consistently paid dividends right through past recessions, and what's the current dividend rate? Relying on these concrete facts is what protects you from the totally unpredictable coin flip of future projections. Remember, there are no good stocks, there are only good prices.
Next up, mistake number 5, ignoring diversification.
You really have to beware the illusion of conviction. Placing way too much money into too few assets guarantees that a single error is going to permanently wipe you out. Just look at the catastrophic failure of the Penn Central Railroad. Back in 1968, this was widely considered a completely stable, established giant. It traded safely at $86 a share. Investors poured their savings into it, totally confident in its dominance. But beneath the surface, they were secretly drowning in debt and hiding terrible performance. By 1970, the stock plummeted to just $5, and the company filed for what was, at the time, the largest bankruptcy in U.S. history. If you had put half your portfolio into Penn Central, your wealth was permanently destroyed. Even the safest-looking companies can harbor fatal flaws.
Graham knew that even perfect analysis can lead to wrong outcomes simply because the future is, genuinely uncertain. So he developed mathematical strategies like finding cheap net stocks. That's where you calculate current liquid assets, subtract literally all liabilities, and buy only if that number is higher than the overall market capitalization. But here's the catch. Even with this incredibly safe formula, Graham insisted investors must hold 10 to 30 varied companies across different sectors. Because if one fails, it's just a paper cut, not a decapitation. You absolutely must have broad diversification so no single failure can take down your whole portfolio.
And our final trap, mistake number 6, forgetting the margin of safety. Graham called this the master concept of investing. It is the one principle that humbly acknowledges, hey, you will inevitably be wrong about the future sometimes. Engineers understand this perfectly, right? When they build a bridge expected to hold a 10,000-ton load, they don't build it to hold exactly 10,000 tons. No way. They build it with the capacity of 30,000 tons. Why? Because materials have hidden flaws, calculations have errors, and crazy unexpected storms happen. Well, investing works the exact same way. If you analyze a company and determine it's worth $100, you don't buy it for $100. You buy it for $65. That $35 gap, that is your margin of safety. It's what cushions you against unexpected market shocks, bad management decisions, and broader economic downturns. And this concept actually operates at a market-wide level too. Think about it. If an overall stock earnings yield is sitting at 9% and safe bonds are paying 4%, you've got a solid 5% margin of safety cushion for taking on the extra risk of buying stocks. But when periods of massive economic prosperity hit, stock prices shoot through the roof, which drives their yields down. Once stock yields drop below safe bonds, your margin of safety vanishes entirely. You're basically taking on maximum risk for minimum reward.
So, that brings us to the next step. Choose your investment path. Understanding what not to do is really only half the battle. Now you face the final decision that every investor has to make. Graham outlines 2 distinct paths. Path 1 is the defensive investor. Honestly, this path is for most people. You calmly accept market averages by following highly disciplined, frankly, sometimes boring rules. You hold strong companies, you diversify broadly, mix your stocks and bonds, and completely ignore all that short-term market noise. Path 2, however, is the enterprising investor. Make no mistake, this is a demanding second job. It's incredibly time-intensive. It requires immense intellectual honesty to dig into neglected, deeply undervalued sectors and truly calculate what businesses are worth while the rest of the world just ignores them. Both paths work, but you have to choose the one that actually matches your temperament and the time you're willing to commit.
Ultimately, the market is always going to swing wildly between fear and greed. Mr. Market is going to show up at your door tomorrow, and the next day, and the day after that, making you highly emotional, utterly irrational offers. But the principles we discussed today in this explainer, understanding true value, demanding that margin of safety, and entirely ignoring the crowd, these give you the armor you need. So I want to leave you with this ultimate question to ponder as you step into your financial future. When Mr. Market makes his next irrational offer, will you take advantage of him, or will you let him take advantage of you?